everything you said just made me think of an article I read recently called Interest Rates, the Silent Killer. And you talk a lot about our mounting interest rate expenses on this growing debt. And I always think of you and Greg Foss when I hear do the math. So you pointed out some of the math on stage at the Ski Summit. Can you talk us through that a little bit?
Yeah, it's pretty simple. So the Congressional Budget Office puts out reports periodically. There was one last May, which I keyed in on a lot of our discussions. And then they just put one out a few weeks ago again. And so this is the Congressional Budget Office. Like they are looking at the numbers. They're looking at all of the expenses that we have, all of the programs, and they're adding it all up and putting it in a big balance sheet and in kind of an income statement. And so they add it all up. And when you look at what we have, what they expect in 2023 and 2024 for the next 10 years, this year, and remember that these are very optimistic projections. Okay, so basically you have three main components of the Treasury's their expenses and revenues, right? So you've got entitlements, which is like Social Security, Medicare, Medicaid, and you've got defense spending. So these are things that are either signed into legislation or they're long-standing contracts that they have to be paid with, like Lockheed Martin or Boeing or whatever, right? So they can't get out of these expenses. These are mandatory pretty much, right? And then you've got your revenues, which is your tax base. So they say revenues. It's not really revenues. They're just collecting money from our production. It's not their production.
Right.
They're collecting from our revenues, right? So, but anyway, so if you just look at those three pieces, well, if you've got your entitlements are $3.8 trillion annually. You've got your defense spending, which is about, right now they're saying it's $800 billion. We know it's more than that. Ukraine is stuffed in other channels.
Right.
Like we don't see exactly what's going on, but let's just pretend that that's what it is. So now you're at 4.6 trillion, right? They say that the interest expense on our debt is going to be $700 billion this year. But the Treasury just came out a few weeks ago and said they need to issue $932 billion of bonds this first quarter. So
up $300 billion from what they expected.
Exactly. So something is not adding up. And so we've had a cost of living increase for Social Security. We have a lower, like our revenues are decreasing, right? So they're projecting $4.8 trillion of revenues this year, tax collection. But we just added up everything, and it's over $5 trillion. It's about $5.4 trillion of expenses. But that's without the next problem, which is every single time that we retire a bond, it matures, a U.S. Treasury matures. Since we're operating in deficit, we're not making enough money to pay off those old bonds. What do? Well, we have to issue more debt to pay those. So you're paying down a bond that's maybe yielding 0.75 or 1.25%, but you're having to issue a bond that's yielding anywhere from 3.5% to 5%.
It's crazy.
So you've talked about this before. It's like, we're using our MasterCard to pay for our Visa. I love that analogy, and that's exactly what we're doing. But the problem is we keep running up this other MasterCard bill, and to the point where we have to take out another MasterCard. So there's no way out. If the United States, and you've heard me say this before, if the United States was a company trading on the New York Stock Exchange, it would be a zombie company. Yeah. Because we can't pay for our interest on our bonds with our revenues. It's just the math doesn't. The math is the math. And these are the numbers that are published, right? And we know that they're worse.
Right.
They're worse because you think about the Congressional Budget Office, they don't do this in a matter of days or weeks. They take months and months to do these reports. So this is old data, they're old projections, and they're low. And so the revenues are projected to be too high, and the expenses are projected to be too low. And so when you actually go through the math, we're going to be at, I think, somewhere between $2 and $2.4 trillion deficit this year. So
wow, it really is crazy when you see those ticker numbers of the 30 trillion debt that's funded, and then the 170 or 80 trillion unfunded, and it's like,
yeah.
We really have had such a privilege being the world reserve currency to be able to do this, but I can't imagine why other countries wouldn't want to create other systems, because how can you continue to go into debt and just perpetuate what you believe to be right across the world? I think other countries are going to say, well, we're going to build our own systems. We've got the commodities, so. Yeah,
that's exactly right. So you're seeing with Russia, they're keeping their oil in the ground. Mark Moss and I were talking about this just the other day, and they don't want the U.S. dollars. Why? I mean, because we can turn off their SWIFT system. We can seize their treasuries. Why would they want those?
Exactly.
They don't. They want the oil in the ground. Lynn Alden put out in one of her newsletters recently. She did some research on this, and she said that 1 barrel of oil in 1913, if I remember all the numbers correctly, was 95 cents. Okay. Flash forward to today. 1 barrel of oil is about $80, right? Mm-hmm. If you were going to buy 1 barrel of gold, or if you were going to buy barrels of gold with 1 ounce of barrels of oil with 1 ounce of gold, then you would, in 1913, be able to buy about 22 barrels with 1 ounce of gold. And today, with 1 ounce of gold, you can buy about 24 barrels. So,
wow.
So the problem is obviously the dollar.
Right.
Who wants to own dollars?
Right.
For their oil? Nobody, right?
Yeah.
So, and that's why you've got the BRICS. You've got Brazil, Russia, India, China, and South Africa. They're all kind of banding together to try to figure this out, using their natural resources and avoiding the dollar as much as possible.